Good morning, everyone. Happy Monday. I hope everyone had a wonderful 4th of July long weekend. Shweta and I are very happy and excited to be with you this morning to talk about what's going on in the markets. This presentation is called Answering the Most Common Questions Being Asked Right Now, and frankly, Shweta, as you know, the most common questions are basically, what do we think is going to happen ahead? So we're doing our best today to help to answer some of those questions as best as we can. And if there are any questions while we're going through this presentation, it is live. Please feel free to use the Q&A. You can find it on Zoom at the bottom of the screen. You can type in your question there, and we have a question summary at the end where we can get to everything. Let me make sure that I can advance the slides. There we go. My name is Natalie Colley. I'm an associate advisor at Francis Financial. I've been here for over 5.5 wonderful years now, and I'm joined by Shweta Lawande. And I'll pass it over to you, Shwe, to introduce yourself.
Thank you, Natalie. Yeah, I have been on the team as an analyst for just under 4 years now. So time really flies, and it's been a great 4 years.
It has. It feels like you've been here forever.
I know. That's what it feels like. I never know if 4 is actually the right number, but looks like it is. So we'll start this morning's discussion with a quick look at where we are today in terms of the trends we're seeing around new COVID cases around the world. And I wish we had better numbers to report here, but the US is clearly leading the pack with almost 50,000 new cases this past Wednesday alone. And at this point, we're even outpacing Brazil, where until recently there weren't really any real measures taken to contain the virus. So the increase that we're seeing in the number of cases in the US is mostly the result of all 50 states starting to reopen in different phases. And while you might expect that the stock market is reacting negatively to the grim numbers, the reality, as we know, is quite actually the opposite. And we'll talk more about that in a bit, but before that, I also wanted to point out the second emerging market after Brazil that is starting to see a new rise in cases, and that is India. And India presents a unique challenge in containing something like COVID because you have this massive, massive population where implementing any kind of restriction on the proximity of people is going to be quite difficult. But Hong Kong is a similar story, maybe not in terms of the magnitude, but the proximity of its population. And they have experienced, I think it's only 6 or 7 COVID deaths in total or in recent times. And so we know it's possible. So from our perspective, I think going forward, hopefully what we'll see from all countries, including our own, is a better effort by the government and the public together to reopen or to stay open in a way that doesn't require this trade-off with public health. But yeah, that's where we currently are.
And you had mentioned to me when we were talking about this last week that, India looks like they have a significantly lower number of cases than the US or Brazil. Now, is that really the case? Or what are we looking at here? Because you would expect them to have more, given what you just said, the density of their population.
Right, and the conventional wisdom around that is, the reporting of COVID numbers, especially when you have this massive system of people, these cases are most likely underreported. And as testing picks up, hopefully we'll see, not hopefully, but we'll probably see the number of cases also increase. But at any given time, it's going to be difficult to rely on the numbers coming out of countries like India and some other emerging markets, just as the reporting of these numbers starts to pick up.
Mm-hmm. Yeah, and interestingly, you had mentioned Hong Kong, and that brings to mind that, there has been a vast divergence in factors that are impacting the number of active COVID cases, one of which is, of course, density of population. That plays a huge role. And then the level of economic stability in the country and the country's ability to provide things like PPE and enact safety measures so that their citizens don't get infected. But another point that I was reading recently was just the mindset of the population within the country. And so Hong Kong, they had been coming off of a series of protesting mainland China, trying to insert their laws and their force within Hong Kong. And so the Hong Kong citizens were really already very much connected. Socially, they had a lot of social networks in place to communicate with each other. And when COVID started, the actual citizens within Hong Kong, separate from the government, enacted a form of protective measures so that COVID wouldn't spread there on the island. And they were really able to tamp down on any cases, which is really surprising given just how densely populated they are. I mean, they're way more densely populated than New York. They're just on top of each other. And they were able to, citizens went around handing out face masks, bringing food and supplies to elderly people so that they could stay home. The citizens themselves were extremely responsible about this, took it really seriously, versus you can see the US, we're much more of an individualistic country, and we're seeing the results of that right now with our continued spike. So I thought that was interesting.
That is, and that reminds me of what we saw in China, where they were able, for such a large country, to be able to contain the virus and keep the number of new occurrences quite low. And I was reading that it's very much a function, as you mentioned, of the way the society works and the way that government intervention is more quickly and easily accepted than maybe some things that have tried to be implemented here. So that's interesting because we think of COVID as this universal threat, but each country is recovering in completely different ways. And I think that's something we're going to touch upon later when we take a look at sort of what the international markets are doing compared to the US, but that's always something that's important to remember.
Yeah, exactly. It's history reflecting back on this time is going to be extremely interesting to see what worked, what didn't. But right now we will focus on, just the US market on this particular slide. So this is the history from the beginning of the year to June 29th, so lagging about a week or so. And what we see here is that there was a really, really sharp decline in the S&P 500. This was the most significant decline that we had ever seen, the fastest decline that we had ever seen in the S&P 500. And that was extremely alarming to a lot of people, experts and day-to-day investors alike. But what the story that this sort of V shape tells is not unlike what we see in typical moments of crisis in the stock market. And so what the stock market tends to do, and I remember talking to clients about this back in March, it tends to overreact to news. On a day-to-day basis, the market is just a big voting machine. Billions of dollars worth of trades are flowing in and out of stocks on a daily basis. And the market is constantly trying to adjust to figure out how good or bad something's going to be. The market hates surprises. And so when it was presented with this big shock of COVID, what we saw was a pretty massive overreaction. Now, looking back, we can say it was an overreaction, but one of the things that really helped the market recover in the US particularly was fiscal support. And luckily, we're here in the US with a very developed country. Developed countries have fared better from an economic standpoint because they've been able to have that fiscal support. And what we saw was the Fed moved faster than ever before to provide the support that the market needed. So in the first 3 months of COVID, the Fed increased the balance sheet more than it increased the balance sheet during the duration of the 2008-2009 crisis. So really, really quick response from the Fed, just pouring money into the system to make sure we didn't reach this gridlock scenario. And that was through buying even now corporate bonds. We're seeing $500 billion of new corporate debt being purchased by the Fed. That's unheard of, has not been done before. The $600 per week unemployment assistance, that $1,200 stimulus check that a huge number of households received. All of these measures helped to provide liquidity in the system, helped keep household spending more fluid, and that's what's really helped us to get to where we are today, which is just a couple percentage points off of where we started the year in terms of the S&P 500. I just checked as of the end of the day, Thursday now, the market was just above 3,100. So almost where we were at the beginning of the year. That's a pretty historic rebound that we also haven't seen before. So very historic downturn, very historic rebound on the other end. But that certainly doesn't mean that we are out of the woods yet, right? So looking forward, you and I have talked about this a lot, Shui, we do have a lot of risks on the horizon. The presidential election is this year. At the beginning of the year, recall we were saying, well, you know, presidential elections, years in which there are elections tend to be years in which the market is up, even if it's just nominally up for the year, despite all of the volatility that can happen intra-year. Now, the one exception is if there is some exceptional event occurring in history, and unfortunately that may be where we are in 2020. But you had some thoughts about the presidential election.
Yeah, so when Trump was first elected, I think that's when we started to understand, or at least observe, that the stock market doesn't usually do what we expect it to, given the candidate that's elected. And in 2016, it was for the better of the stock market. And, you know, who's to say what will happen in November? But people are starting to, you know, extrapolate and make sense of, you know, what can we expect if we see the Trump administration continue for another 4 years versus if we are able to elect Biden into office. And we're existing along, it seems like, this binary where we think that if Biden comes into office, we might see, you know, trade tensions with China dissolve and seemingly dissipate as we're dealing with COVID and other issues with China. We don't know what to expect with another 4 years of Trump, but it seems that whoever is elected in 2020, they're dealing with an unprecedented time in the market and just in our country with the spread of COVID and the second wave, which we're still technically riding the first wave of the virus. So a second wave, as much as it feels like we're at the very kind of crest or the peak of that, we haven't even really approached it yet. And just as you said, in the stimulus measures that were taken to build the recovery that we've seen since the end of March, that was just as, if not more, unprecedented than COVID itself. So it'll be interesting to see if, first of all, additional stimulus is needed based on how we're able to reopen, but also keep the number of new COVID cases hopefully lower than we have in the past. But if it is needed, what could that look like? So you were exactly right. And this is something we talk about in almost all of our meetings with clients, where the only thing we can say with certainty is that there's a lot of uncertainty. And it's something that the stock market doesn't like. It's something that investors don't like. But one of the best defenses we have against uncertainty and market volatility is thinking like a long-term investor rather than a market timer. And so we have some interesting numbers to share with you guys about, what does that mean in terms of actual dollars and the actual stock market as we experienced it for the past 50 years or so. And long-term investing is something that's usually easier said than done because it can be hard to follow the news and not try to move to the sidelines when you're expecting the market to perform poorly. But history tells us that the best strategy for weathering the market under all circumstances is to stay put through the good and the bad. So for example, if an investor started with $1,000 in 1970 and stayed invested through the good and the bad for the next 50 years, they would see that $1,000 turn into a whopping $121,000. Now, in an attempt to target the best days in the market or to avoid the worst days in the market, if that person had missed just 5 of the best days in the S&P 500, so just 5 days in those 50 years, that return would come down significantly to 77,000. And missing 25 days in those 50 years brings it down to just a paltry 27,000. So what we're seeing here is that the key to benefiting from the market is to stay invested. There's no proven way to time this, and a lot of people who did get skirmish around March when the market first dropped and decided to pull out of the market, they ended up missing out on a historic recovery and are probably seeing the effects of that on their long-term performance. So more than anything, if there's anything that we can impart here, it's that, there's uncertainty in the market. It's something we can't control. What we can control is staying invested for the long term and maintaining that discipline.
Yeah, and what's really hard about this advice, and we say it again and again, this piece of advice, which is the best tool you have in your toolkit is to stay invested. But the tough part is that those best days in the market that we're talking about happen during periods of really high volatility. So, the flip side could be, well, avoid the worst days in the market, but frankly, you could have the worst day in the market for the year followed by the best day of the market in the market for the year. And you just have no idea when those days are going to be, and they don't match up with the news cycle. They just don't. A few slides earlier when I was talking about the market really overreacts to news, trying to price in what's happening. It doesn't react to all news. We didn't see any type of turbulence due to the Black Lives Matter protests. In fact, during the first couple of weeks of those protests, we saw the market continue to move upward. So the market, I think the important distinction isn't looking at good news versus bad news. The market is looking at better or worse. So when the market continues to go up, it's looking at, is coronavirus getting a little bit better? Is our economy getting a little bit better? Do we expect there to be a vaccine in a year? And frankly, a lot of it is the market getting comfortable with the news that's out there. So getting comfortable with the mortality rate, getting comfortable with this new reality. That's what the market sort of is looking at, not necessarily what's in the headline today, although, certainly that can also impact it. The other, sorry, go ahead, Shrey.
No, I was just going to add one more thing, just like you mentioned, that the market is looking at if things are better or worse compared to their own expectations. So it's not even sometimes tied to the data in terms of is what we're seeing today better than yesterday, but is today better than what we expected today to be? And so that adds another layer of subjectivity where the market is applying its own expectations and as a result acting today about what they expect to see in the future. And so it's it's one more factor removed from our control when we can't even gauge what the expectations necessarily were for something that's out of our control.
Yeah, no, you're 100%, you're 100% right. And it's only looking forward, you know, in the relative near term, 1-2 years, and constantly the market is getting comfortable, and that just adds so much complexity when if you are trying to actually time it and guess or predict what the market's going to do. So one of the other tools we have in our toolbox is, of course, diversification, because we've talked a lot about the US economy, a little about the overall world economy, but the fact of the matter is, what we were talking about sort of when we started the presentation, different countries have really approached this problem very differently. Different societies have different cultural makeup, and that is what is really impacting getting through this particular crisis, this health crisis. And getting through this health crisis is what is going to get the economy back up and running. So this is a chart of real GDP. You can think of GDP as sort of a measure of growth, economic growth, and that economic growth is going to trickle into growth in the market. And this shows GDP at the top of the chart here. You have the dark teal highlighted column or row. This is sort of at a high level at the world sort of GDP, so economic growth for 2019, projections for 2020, for 2021 as well. And then you can see just below that row, advanced economies. So these are the more developed countries, you know, the US, the Eurozone, Japan, et cetera. And then the second light teal highlight is emerging markets and developing economies. So from a high level, and there's a lot that we could unpack on this slide, but we don't want to be overly, you know, overwhelming here. It's just the overall message is at a high level, we can see 2019 to 2020, certainly a drop. That's not unexpected. The economy really ground to a halt for many, many months for many countries. I would argue for all countries. Now for 2021 though, this may surprise people. This is a good rebound, right? So we can see from 2019, 2.9%, and then jumping to 2021, expected 5.4%. Now, part of this might be unexpected because this is an annual percentage growth, so we're jumping off of 2020 numbers, so you would expect some growth, right? But it's important the message here that's important is that the market and the leading world experts here are expecting us to get through this crisis, and there will be growth on the other end, even if there's not uniform growth across every country, across every sector. And you can see that. Shweta, you were talking about uneven growth in, you know, some of the emerging market countries.
Yeah, it's interesting because emerging markets, we think of them as, you know, one asset class, but the components of this asset class are very different. On one end, you have countries like Taiwan and Hong Kong, which primarily rely on exporting goods out of the country for their GDP growth. And so far, for those types of countries, they've been faring pretty well in terms of being able to continue to do that. Now, countries like India, on the other hand, which rely more on domestic consumption, those are the ones where we expect to see, you know, a harder to achieve GDP growth. But another interesting aspect here is that for many months now, and especially now in the wake of COVID, many developed countries like the US are looking for ways to diversify their supply chain away from China. And the beneficiaries of this will likely be other emerging markets like India, Brazil, and perhaps even, you know, Saudi Arabia, South Africa. And so for a lot of people who at the start of the year when COVID first hit these countries and kind of made its way over to developed markets, I don't think it's right to say that emerging markets should be discounted at all at this time. For a diversified investor, emerging markets have and are going to continue to play a very important part in your portfolio. And even though, as we mentioned, COVID is this universal risk that affects almost every asset class, each market is experiencing and is going to experience their recoveries differently. And for people who invest in more than one market, this is going to be a source of stability for their portfolios and for their long-term returns.
And one thing that we have seen is, the United States, very developed nation, we were able to use fiscal support to really help us bridge this period and stabilize our market here at home. But part of what that entailed or required was the printing of a lot of US dollars. And the US dollar has been doing phenomenally well. It's been the dominant currency in the world for years now. That has really, the strength of the dollar has really hurt returns in emerging market countries. And going forward, because now we have put so much, we've really flooded the system with US dollars, we could be seeing a point at which the value of the dollar tops off and even maybe enters a bear market. And so the weakening of the dollar will actually serve to help returns in emerging markets and non-US markets as well. So that will be an extra tailwind for those countries as we move forward in the next several years. So they are poised from several different positions or, viewpoints to outperform US stocks over the next, 5, 10, 15 years. But let's zoom out even more. And I love this chart. If you can walk us through this.
Absolutely. And the more I look at this chart, the more I really appreciate what it illustrates. So what we're looking at here is the S&P 500 index over a vast amount of time. So from January 1926 to December 2019. And the areas highlighted in teal are where you're seeing this market run up, and the areas in red are market downturns. And first of all, you can see that they are few and far in between. But what's really interesting here is you can see that in a downturn, in a market downturn, there's no real way to predict how long it's going to last. And more often than not, the recovery has already begun before it appears to most. So, it's not this gradual return to the base level before it starts to increase. And I think that just drives home the point that market timing can be a foolhardy endeavor. And for someone who was just invested in the S&P 500 during this time without trying to, pull out of the market before it experienced a downturn or entering just at the time that the market is going to peak, they wouldn't have experienced nearly the kind of returns. They wouldn't experience the kind of returns that a long-term investor would.
Mm-hmm. And one thing that jumps out to me about this chart also is if you look at those red downturns and you look at the amount of time, so 16 months, 25 months, it's a little hard for me to see on this laptop, 5 months, 3 months, 20 months, we're talking about relatively short periods of time here. So the message here is that when we think of growth of the market and we think of the economy, those sound like very abstract, hard to comprehend and understand things. And there are a lot of variables that go into this, but at the most basic level, economies, not just here in the US, but all across the world, it's about growth. It's about innovation, moving forward, people advancing their own personal economic standing, that of their families. It's about general human advancement. And we may go through periods where we have setbacks, but overall that doesn't change long-term human behavior and that need and drive and desire for growth. That outweighs, you know, these small periods of time where we experience these challenges. And that's where I, during periods like this, get my hope from is, you know, long-term perspective. We will get through this. There are industries that have been hit particularly hard. Obviously, travel and hospitality have just been crushed. I think it's going to be a very long time before those go back to normal. They are going to need a lot of support going forward. But there are other parts of, you know, other sectors that have performed extremely well. And, you know, think of all of the progress we've made now in work from home technology because we've been forced to, and the companies that have really benefited from that and the new companies that will be developed because, you know, to support this new work from home era. So there's always hope. It may take us some time to get there, but important to keep in mind that the length of time that we're seeing these challenges, you know, even throughout history, relatively short in the grand scheme of things. So, Shweta, can you see if we have any questions? It's a little tough for me to see on my screen. Of course, we don't want to forget this.
Yep, so far nothing in the chat. If you have any questions, please feel free to enter them into the chat in the Zoom meeting, and we'd be happy to answer them.
And while we're waiting to see if anyone has questions, we always want to, you know, focus first and foremost during this crisis on taking care of yourself and your family. And a lot of that is mental health, physical health, because there is an undercurrent of just stress at this time. So we're, you know, on our end trying to do our part to bring people together, move a little bit, especially in work from home where I find myself sitting 99% of the day now, even more than at work for some reason. So we are hosting every Thursday at 5:30 a workout class. Our next one is this Thursday, July 9th at 5:30. It will be yoga hosted by our very own yogi extraordinaire, Deborah Donnenfeld. She's fantastic. People of all levels can join. You just join the Zoom link. You can hide yourself. You don't have to actually show your screen if you don't want. And then alternating weeks, we do strength and HIIT type workouts with personal trainer, Dr. Laura Miranda. So they're typically around 30-minute workouts, really fun, great way to come together and see each other and just release a little bit of tension that has built up throughout the week. So hope to see you there. Anything else that I'll stop sharing my screen? Anything before we let everyone go, Shui?
No, but to answer, Lisa, your question here, yes, this will be available as a video as well. So after all of our webinars, for anyone who wasn't able to join us live this morning, we will upload these videos. We'll go ahead and share them as a link to anyone who's interested, but we'll also upload them to our YouTube channel where you can find all of our webinars, all of our quarterlies, our everything that we do on Zoom here.
Yep, and these will be ongoing monthly webinars where we're just connecting at any two of us in the office about things that we are hearing from clients, things that we are talking to each other about. We're a close-knit group, and we talk about this every single day. So thank you to everyone for joining us, and I hope you all have a lovely, lovely week ahead. All right, bye.
Bye.